Well, welcome back to the Financial Pulse Radio Show. I'm your host, Danny Howe, CEO of East Coast Tax and Financial Planning. And if you're just joining us, I hope you had a wonderful Thanksgiving. And we are talking about market risk and particularly the investment policy statement that is a crucial element to a successful financial plan for anyone. And if you're just tuning in and maybe you're younger, you're in your 30s, 40s, and you're putting money away into a 401k at work, or maybe you're a business owner and you're trying to put some money away in your own 401k or just IRAs, brokerage accounts, and so forth. Or if you're almost retired, maybe you're over 55, maybe you're even over 60, and you're got 1 foot in the door, 1 foot out of the door of retirement, and then you have another segment of people that might be listening that are already retired, maybe you've been retired for a decade or two already. It doesn't really matter where you are, and it doesn't really matter where you are on the economic scale as far as how much money you have invested. As far as what how you determine your investment policy statement. Everybody should have one. And one of the biggest tragedies for just financial awareness and understanding that I see, just the financial illiteracy on everyday type of things, is the fact that because we typically go to work for a corporation or a company, whether it be a small business or a large corporation, they will have different retirement planning options, usually in the way of a 401k, or if you're a municipality worker, a 403b or 457 plan. These are tax-deferred retirement plans you could put away and save money now on taxes and have that money grow tax-deferred so that you don't have to pay taxes on that money until you decide to take money out. And then you'll pay ordinary income tax on all the distributions out of those retirement plans. In that, though, there's a huge disconnect. So if you think about when you get hired, or maybe periodically when you go into your online account and you look at your 401k or 403b, you can go in, you can check off a couple boxes, you can answer a couple questions about risk tolerance, and just kind of choose a couple. Mutual funds are typically what are used in 401k plans, and you just kind of let it ride. And there's a huge disconnect there because there's no real financial planning involved in that other than just, okay, what's your risk tolerance? Or really even worse, just, hey, which funds do you want? There's really very little that goes into, assessing where you are, where you want to be, reverse engineering how much you need to make or how much you want to make and how much risk you're willing to take in order to make smart decisions. And if you don't get anything out of this group of people that are working, you have 401ks and so forth, go ahead and open those statements. Go online, log in, and see what your investments are doing. See how they perform the rest of the year. And then ask yourself this question. Brush up. Take a look at what the markets have done so far this year. Think about the fact that we just had a major election and we've had some changes in our legislative structure. So now decisions that going forward are going to be made a little bit different. Policies could be different. And then on top of that, we've had a long run of a good market. And, last year, 2017 was a stellar market going into the beginning of 2018. But then we saw some hiccups in the beginning. And then now we've seen pretty much all the gains for 2018 virtually erased in all the major indices. And so how do you respond to that? And in the last segment, we talked about the importance of having an investment policy statement. That investment policy statement obviously has risk versus reward involved in it. And there's typically risk assessments that you can take. We use a couple different systems, but I like to use the systems that actually identify the dollar amount that you're comfortable with. Instead of looking at percentages like, I don't know, scratch my head, I guess I'm willing to take a 10% hit, or I'm willing to take a 5% hit. The big thing is to look at the dollar amount of what that hit actually means. Does 10% $50,000? Is 10% $100,000? Is 5% $50,000 or 100 or whatever the number is? And when you look at that number is going to cause a reaction from you. It's going to either cause a I'm fine, no big deal. Or it's going to cause I'm not happy with that at all. It's like, well, you just said you were fine with 5% down or 10% down in a market that's not doing so well. Yeah, but looking at that number, I would feel really upset if I lost $100,000 or $70,000 or $50,000. And, okay, if you're really upset, what's your reaction? Well, my reaction is to make a change. What kind of change? Probably to get out. Okay, so you're going to lock in that large loss because of the fear of that number being where it is. Once we identify that, then we kind of shrink it up and we say, okay, well, if that's uncomfortable for you, then what number is? In other words, the market isn't perfect. The only thing that's certain about the market is it's uncertain. The only thing that's predictable about the stock market is that it's unpredictable. Nobody has a crystal ball, and if I did, I probably wouldn't be on the show right now. I'd probably be on my own private island, just looking at my jets and cars and things like that, right? So if we know that there's going to be swings in a market up and there's going to be swings in a market down on a second by second, minute by minute, day by day, month by month, quarter by quarter, year by year basis. There's going to be gyrations in the market due to buying and selling and just a natural course of things when it comes to stock market investing. So once we figure out that sweet spot of like, okay, well, if I could have the opportunity, the reward to make 10%, but with knowing that statistically speaking and historically speaking that I shouldn't endure a loss of more than, say, 5% over a certain period of time, maybe it's a 6-month period of time, a year period of time, whatever we're measuring, then that's how you find your sweet spot to help you sleep well at night, knowing that you are going to be investing according to your investment policy statement that says we are going to try to keep in this range. We're only going to take as much risk for the reward that we're looking to get. And when we closed out last segment, we talked more about the reward. We said, okay, or we ended on the reward. We said, how much reward do we want? And that's a very tricky question. You got to be able to make sure that's an honest one and it's an honest answer. And the question, is framed in a number of different ways. The question is, how much money do you need to make sure you don't outlive your money? Just if you were to just meet all your daily basics expenses and so forth and maintain your lifestyle. But there's another element to that question, and that's also, what if something happens? So it's not only enough to not outlive your money, but what if something big happens along the way if you're retired, like a long-term care event that costs a significant amount of money, or a premature death where there's a huge loss of income. All those variables are just air conditioners going out and so on and so forth, or hurricanes coming through. If those big expenses pop up, does that derail me outliving my money and maintaining my lifestyle? So now I have multiple fronts on my money. If you think about all the threats to your money, it's more than just whether the Dow Jones is up or down. That's a very important part of it when you're investing. But then what are you investing for? Well, you're investing this money for your future to be able to make sure you don't outlive your money and so on and so forth. So then you have to also take into consideration these things that are outside the stock market. Those what-ifs in life that I talk about so often, those issues that can pop up, whether it's there's a downturn in the economy, we want to help our adult children because they have children, we make sure that they got food on their table, or there's a downturn in the economy and our business is down 10, 15% just because everybody's down, or there's a bear market and there's a big hiccup and so that's derailed my investments. I was going to retire in 5 years, but now it looks like it's going to take maybe 10 just to get my investments up to where they were before the crash. All these things go into helping you identify how much risk you're willing to take. But then that reward is how much interest, how much gain, how much return on my investment do I need to make in order to meet the expectations that I'm setting forth. In order to meet those expectations that even if all those things happen, A, B, C, those things that can pop up in life that derail or cost a lot of money, I could still most likely handle those things, or we have enough insurance and things like that in place that we can make sure that we're going to be able to continue to make, live our desired lifestyle. This is just a tip of the iceberg, folks, on when you're thinking about the market that we're in now, the volatility that's heated up, and just how there's a lot of anxiety almost of, is the good stuff over? We don't have an indicator that 100% that the good stuff is over. But it's very important at this time of the year, especially going into a new year, and then with what's going on in the market, to go ahead and sit down and look at all these things. Find yourself a risk tolerance. If you don't have a financial advisor, find yourself a risk tolerance assessment online, do a Google, take it, figure out where you are and compare that to your investments. And if you have a financial advisor, ask them, what is my investment policy statement and what is your plan for when things don't go right? because that's crucial. It's not about getting it when it's really great. It's about when things don't go right is when they start making their money. Well, just like always, we're out of time. Every single Thursday right here at 10:30 a.m., go ahead, go to our website, eastcoasttaxandfinancial.com. You can listen to past radio shows. Our podcasts are on there. We have blogs on there, and we're just filling it up with more and more information. I'm Danny Howes for the Financial Pulse. We'll talk to you next week. Make sure you're protecting that money, folks, but most importantly, make sure you know who and what you're protecting it from. We'll talk to you next week.